Welcome, and let's start with the crude prices first, which have recovered slightly after undergoing its steepest decline in last 5 months. Prices continue to stay close to this year's lows. The weak economic data and swelling inventories in the US have dented the demand outlook, thus hurting the prices. On your screens, very flat NYMEX, but you have seen some gain up coming back in case of the Brent crude prices, nearly 0.5% of a gain coming in there. Meanwhile, the gold prices also declined to a 10-month lows as investors sold the yellow metal to cover steep losses in equities. Disappointing US private sector job reported impacted the equity markets, but monetary easing from Bank of Japan could help safe haven metal to recover in the coming days. All eyes, of course, have been on the ECB monetary policy meeting, where we have been listening to those flashes which have been on your screens. Everything seems unchanged onto that right now. Gold prices, in the meanwhile, nearly 1% of a decline below 1550 on your screens is how Europe is trading. Dominic Schneider, UBS Wealth Management, now joins us on the show to give his view on all of these commodities that we just talked about. Dominic, hi. The gold prices are down more than $50 an ounce this week at 9-month lows as investor holdings decline. And as buyers go on sidelines awaiting more declines, what's your sense on the sharp decline in gold and the forward outlook?
If you look at the weakness in gold, it really relates to the fact that there is no inflation pressure around, especially in the developed world, and with the dollar trading on the strong side, there's not much interest from financial investors to actually pull into the yellow metal. I don't think that's going to change in the very short run, so we're going to test the 1525 in the coming days, and with the risk factor to actually test 1450. So investors should not expect much of an upside over the next 3 months. Nevertheless, despite, let's say, this soft patch that we see in the gold price, I still stick to the view that in the long run you're going to see higher prices to really rebalance the global economy, to get rid of all the debt that we have in the developed world. I think higher inflation is needed, and I think that will turn investors away from cash, from currencies, into real assets, and that will definitely benefit gold.
Sure. Dominic, it's not just gold, but silver also trading at an 8-month lows and platinum at 3-month lows as well, which is now yet again back to discount in gold. Where do you see support kicking in for these precious metals?
With regards to silver, we do expect around $26.5, $26 an ounce, some technical support. And I think key factors to really look at is, first of all, gold. When gold weakens, normally silver does weaken much more. And the other factor relates to the macroeconomic data that came out, which actually disappointed market expectations and probably dented a little bit the outlook for industrial application, which still accounts for 50% of overall demand. So with these two factors in place, you need to be a little bit careful that these support levels probably are rather soft and really hard floors. In the case of platinum, if you look at we are trading into the production cost curve, there are a lot of producers being challenged. There are wage negotiations going on in the coming months. I think that clearly gives you an indication that prices shouldn't fall even further. This also depends obviously on the global economy, as its use is tied to the auto industry. I think that needs to be considered. Overall, if your view is that the economy starts to recover into the second half, both of them should actually do pretty well, I would say, with a trough in the second quarter.
Dominic, not just the precious metal space, but you have seen the decline coming in for copper prices as well, which are weighed down by weak factory orders in China and US, also high global inventories. Where do you see prices headed for this one?
With regards to copper, the short-term story remains a little bit constrained as well, simply related to the fact that the numbers that came out of China are not that supportive. What we need to see is really an acceleration in industrial activity, and so far it's not yet taking place. If you look at the leading indicators and if you look at what happened on industrial production side. So the lack of growth acceleration really keeps on inventories going up, and that clearly burdens prices. I would say price dips below $7,000 a ton should be used to actually build up some position, and that really relates to the thought that China